Thanks a lot for the invitation. I'm very happy to be part of this unique event with a lot of other experts from all over the world. And we are also very proud to be a sponsor of this event with Investui and WH Self-Invest. So welcome to my presentation, Better Investing Using Market Effects here at IFTA's first online conference ever. Before I start, first of all, the mandatory risk disclaimer, for which I will give you a short period of time to read it carefully. Trading futures or CFDs sustains substantial risk of loss and is not suitable for all investors. And of course, past performance is not indicative of future results. So let's move on to our topic for today. Over time, many investors or traders develop complex investment strategies and try quite often to optimize them. As an investor, however, one does not always, let's say, have to reinvent the wheel, but it is quite often sufficient to use relatively simple, proven approaches and strategies and implement them consistently. Such strategies use, for example, seasonal patterns in the financial markets, which are also called market or calendar effects. A lot of scientific studies by academics prove the existence of these market effects, which are used by professional investors to achieve above average returns. So there is a lot of value in it and worth to have a closer look into them. In this presentation, I will focus on 4 different strategies based on reoccurring market effects. These are the Turnaround Tuesday, the Friday Gold Rush, the Pound Shorter, and the End of Month effect. So let's start with the Turnaround Tuesday effect. Turnaround Tuesday is a well-known market effect. Make sure your own shares on Tuesday is a traditional saying on the stock exchange. Additionally, the existence of the Tuesday effect is supported by strong statistical data. For example, the research agency Evercore calculated that not having the S&P 500 in the portfolio on Tuesdays results in a decrease of the average return from 9.1% to 6.5% when going back to 1980. And likewise, Mike Bird in the Wall Street Journal writes, and allow me to quote, since the beginning of 1980, the S&P 500's average Tuesday gain has been 0.07%, the best of any day of the week. Remove Tuesday performances from the index over those decades, and its gain shrinks from nearly 2,500% to only 560%. So you see that Tuesday has a huge impact on the performance. Due to this statistical evidence, many active investors have a strategy to benefit from the Turnaround Tuesday effect. The strategy I'm showing here uses the German market index DAX, or to be more precise, the mini DAX future. This market effect shows an outperformance of the DAX even when the index is strong. It shows a good and stable performance over the last 11 years, which you can see in the chart on the right. This one shows the gross profit generated by the Turnaround Tuesday effect based on this time period. The profit is based on a position size of one futures contract in the mini DAX, which is €5 per point. The strategy also has a positive psychological effect. The investor feels he's buying low, which brings us to the strategy in more detail. Only when the DAX shows signs of weakness based on technical analysis, a position is bought on Monday evening and sold on Wednesday morning. How is this weak market environment recognized? Therefore, a 34 moving average is applied to a daily chart of the mini DAX future, regular trading hours only. You see this here in the chart on the right. You also see that the default interpretation of the moving average is kind of reversed. When the market is below the moving average, like here. The background is colored in green, which means that on Monday a signal is generated by the strategy. When the background is red, no position is opened by the strategy on Mondays. So during the whole summer, this year, for example, when the market showed a strength and moved up and recovered from the crisis, there were no signals created by this strategy. On the next slide, you can see some facts and figures about the strategy. The percentage of winning trades is around 60%. The average winner based on one mini DAX future is around 600 euro, and the average loser is around minus 500 euro. Quite often I get questions from people who ask if such market effects also work when markets are quite turbulent, like in March, for example, during the COVID or Corona crash. And the simple answer is yes, especially after a market crash. Tuesdays were quite often the days of the week when market sentiment became positive again. For example, you had this in the big crash in 1987 in the Dow, for example, or also around 10 years later in 1997, when we also had a big down move in the US markets, for example. In the chart on the right, you can see the best trades during the last 11 years of the Turnaround Tuesday strategy, which took place during the Corona crisis. The position was opened on Monday, the 23rd of March this year, and closed on Wednesday morning, the 25th, with a profit of 1,263 points, which means 6,315 euro with one mini DAX futures contract. How does this strategy work? Or not how, but why? So let's look at some fundamental reasons here. For a number of reasons, Tuesday is the optimal day for a positive change in market sentiment. For example, bad news published during the weekend are processed in the market price on Monday and is digested by Tuesday. In weak markets, large investors take profit on Friday to reduce the size of their positions held over the weekend. On Tuesday, they start quite often to building up positions again. Investment funds also close positions on Friday. They often increase their cash position for Monday in order to service investors who gave instructions to exit during the weekend. And finally, also private investors quite often liquidate positions on Monday when bad news is published during the weekend. And investment funds try to buy the shares at a lower price on Tuesdays. So let's continue with the second strategy, the Friday gold rush. Gold is a financial instrument which also shows a typical calendar effect. Put simply, the gold price tends to rise before the weekend. This market effect is subject also of a lot of academic studies. For example, the economists Yu, Li, and Shi conclude in their academic study weekday effects on gold, Tokyo, London, and New York markets. Friday shows positive and significant higher returns on gold. Also, the economists Draper, Pfaff, and Hillier in their study Do Precious Metals Shine? An Investment Perspective come to the important conclusion that portfolios which contain gold, silver, or platinum perform significantly better than standard equity portfolios. This strategy shows a good performance since the last 20 years. In the chart on the right, you can see again the gross profit generated by the Friday gold rush strategy in a backtest over the last 11 years. The profit is based on a position size of one futures contract in gold. You can see that the returns, for example, are more volatile compared to the Turnaround Tuesday effect, for example, the first market effect I just showed you. And the strategy also has a transparent and understandable logic. This strategy stands out due to its simplicity. Buy gold every Thursday afternoon and keep the position a bit more than one day and close it on Friday evening. A lot of experienced investors or traders use versions of this strategy. The percentage of winning trades is around 56%. The average winner based on one gold future is around $1,182, and the average loser is around minus $1,195. Why does this strategy work? Before the weekend, different parties for different reasons buy gold. Buying gold on Thursday evening is therefore statistically interesting. Firstly, gold is mainly used in jewelry production. For security reasons, the jewelry industry works with very limited stocks. Companies tend to buy their gold on Friday for delivery during the weekend or the next Monday morning. This way, they have just the right amount of gold to keep all their employees active during the coming week, and thereby also avoiding kind of expensive weekend work, for example. Secondly, gold is used by many investors as a safe haven. So gold serves actually as an insurance policy against a stock market crash or other hard to predict risks and uncertainty. This is particularly true during the weekend when markets are obviously closed and the risks are higher. So big investors therefore increase often their gold positions before the weekend and buy gold on late Thursday or on Friday. Let us also look at an example here. Recently, there was one of the best trades in this strategy over the last 11 years. On Thursday, the 8th of October, just around 2 weeks ago, a position was opened at a price of $1,898.7 in the gold December contract and closed 1 day later on Friday evening, the 9th of October at $1,934.4, which resulted in a profit of 35.7 points or $3,570 with one gold futures contract. On the right, you can see a chart of this particular trade. The third strategy, the pound shorter, is based on the relationship between the British pound, the GBP, and the US dollar. In 1858, an undersea telegraph cable was laid between the United States and England. This telegraph cable was used to transmit instant information between continents regarding the exchange rate of the pound versus the dollar. Ever since those days, investors refer to the GBP-USD Forex pair as cable, as you probably might all know. If you have now a closer look at this currency pair, what you can notice is that the price of the GBP-USD tends to go down on Tuesdays in the first half of the day. This is the market effect with the most stable results compared to the other three effects I'm presenting here today. On the right, you can see again the cross performance over the last 11 years based on one GBP futures contract. If you trade this market effect, you don't have any overnight risk because the position is only held intraday. So short position on the GBP US dollar pair is opened on Tuesday morning for a bit more than 6 hours and closed in the early afternoon. The percentage of winning trades in this strategy is around 55%. The average winner based on one GBP future is around $265, and the average loser is around minus $243. This micro pattern of repetitive weakness in the GBP US dollar is not so popular like the other market effects, but gives good and stable results. One of the top 10 trades in the strategy during the last 11 years was, for example, this year on Tuesday, the 17th of March. A short position was opened in the morning at 1:22.54 and closed in the early afternoon Central European time, of course, at 1:21.21. This resulted in a profit of 133 ticks, which is a monetary-wise profit of $831.22 with one GBP futures contract. Let's move on to the last market effect I want to present today. The end of month effect has been subject of many scientific studies. It's perhaps the most popular one. Maybe you also might know it by the name TOM, T-O-M, turn of months, or different names. Statistics show that stock prices, and in particular US stock prices, tend to go up during the last days and the first days of the month. The economists Laconi-Schock and Smith calculate in their study, are seasonal anomalies real? A 90-year perspective that most of the average annual return of the Dow Jones Index over the period 1897 to 1986 was realized in the first and the last days of the month. Incredibly, keeping a position during the rest of the month contributes very little to an investor's return. The economists Cacciano and Tonero in their study Calendar Anomalies in Stock Index Futures write, our analysis shows that the end of month effect in the S&P 500 future is statistically and economically significant over a long period of time. This backtest on the right uses the S&P 500 market index to benefit from the end of month effect and is based on one E-mini S&P future. But this market effect also works in a lot of other stock markets, so it's up to you to choose the one you might prefer. This strategy opens a position 4 working days before the end of the month and sells the position after the 4th day of the next month. Many experienced investors or traders use similar strategies or variations of it. Some open the position a bit earlier or later, or close a bit earlier or later, but nevertheless, it does not change much in the overall result. The percentage of winning trades in this strategy is quite high with 64%. The best one of the strategies I'm showing here today. The average winner based on one E-mini S&P future is around $1,952. And the average loser is around minus $1,856. Why does this strategy work? Economists definitely agree on the existence of the end of month effect. Opinions differ a bit on what precisely causes the effect. Broadly speaking, the effect is caused by a conjunction of significant changes in stock order flows. At the end of the month, the composition of large funds and insurance portfolios is adjusted, and changes in the composition of the stocks which make up market indices, as well as mergers and acquisitions, also have an impact on the large stock flows. Looking at the results, it's notable that also the best trade during the last 11 years took place during the COVID or Corona crisis. The position opened 4 working days before end of March this year at a price of 2,419.5 in the mini S&P future, was closed after the 4th working day of April at 2,691.75. So a profit of 272.25 points was realized, which are $13,612.5 in the mini S&P future traded with 1 contract. On the next slide, you see on the left side the cumulated gross profit from the last 11 years of each strategy. The chart shows the gross profit per strategy, let's say. To make comparison possible, the backtest is not based on the real position size of one futures contract, but an identical position size in money terms. The Friday gold rush, for example, here in orange, the orange line is among the most profitable ones, but results are more volatile, as you can see. The pound shorter, for example, the dark blue line, generates less profit, but the results are more stable. What's really interesting is the chart on the right, which shows the gross profit for all 4 strategies combined based on a backtest over 11 years. The position size here is again 1 futures contract for every position. What you can see here is the equity curve is much smoother compared to the individual ones on the left. So it definitely makes sense to not only trade one of these market effects, but a combination of more effects. For example, these 4 calendar effects I just presented. On the one hand, the mix of 4 strategies diversifies risk. And on the other hand, the mix of 4 instruments also diversifies risk. We have here 1 commodity with gold, 1 currency pair with the GBP US dollar, 1 European index, the DAX, and last but not least, the S&P 500. That's basically it because the time is limited and there are many more great experts coming next. So first of all, many thanks for your interest and attention. We are very proud to be a sponsor of such a great event like the IFTA conference this year with our 2 brands Investui and WH Self-Invest. If you want to learn more on these market effects and find, for example, all the related academic studies and read them in detail, feel free to visit investui.com. It's a service to invest based on these market effects, fairly easy, especially if you have limited time to do all the work by yourself. I personally did a lot of research on these market effects and helped to develop this brand and service. If you have any additional questions, we will check for some questions now, but if you have any additional questions, you can also contact me directly. You can see here my email address. If you are looking for a reliable European broker with excellent references, feel free to check out WH Self-Invest. So thank you again for your interest and for having me here. And Wieland, do we have some questions here? Or
Sure, Roland. First of all, thank you so much for your great presentations. There's a lot of positive comments coming in, really great. We have 3 questions right here. So first of all are the profits of the strategies are calculated with fees? I think the fees will eat them up. How is it?
it shows the gross profit, these backtests without fees, but on our website we have a real accounts where you also see the net profit when all the fees like commissions are already debited. You can just have a look there, and it's definitely not the case that the fees eat them all up, because it's not these are not scalping strategies. In most of the strategies you have one signal per week, or in the end of months only one signal per month. So you do not have that many trades, and therefore the costs are quite low if you trade these market effects.
Right. Okay. So second is a Friday gold rush only works on gold market, or does it have a positive impact on mining stocks as well?
I did personally not check the strategy in mining stocks, so I unfortunately cannot comment on this. We only tested it on gold directly, on gold futures and also gold CFDs, for example.
Okay, understood. And last one is, how should your 4 strategies be weighted? 25% of the capital on each?
I would recommend to weight them in the same way. So 25% of the capital per strategy sounds good for me, but you can do it like you want. If you prefer more the end of month effect and like to invest more in indices, perhaps more than in currencies or gold, you can also wait, for example, the turn on Tuesday or the end of month effect a bit higher than the other ones. So it's up to you. But overall, I would weight them more or less equally.